Hey guys, welcome to the anatomy of a candlestick. So if you're brand new to trading, then understanding the anatomy of a candlestick is going to be your first foundational step to technical analysis. Completely understanding how to read candlesticks plus how to read trend and structure, which are two other things we're going to dive into with a lot of detail throughout the basic section of this course, are going to be the foundation for your ability to successfully predict market moves using technical analysis. So if you are in any way having trouble understanding what these candlesticks represent or how to read them, then I would suggest watching this entire video. Let's go ahead and dive into it now. So what is a candlestick? Well, a candlestick is a representation of a certain time frame. And before we get into what these candlesticks actually represent, let's go ahead and talk through what it consists of. So each candlestick consists of four major points. We have our open, which is right here on a green candlestick. It would be the bottom of the body, because this green part here is called the body of the candle, and these wicks or shadows, we'll refer to them as wicks. The lines you see at the bottom and the top of the candle, those are going to be the wicks of the candle. So at the bottom of the body of a green candle is going to be the open, and as I said, we have four major parts of a candle. We have the open, the low, which is the lowest point that the market got to during this particular time frame that the candle represents. We have the high, which is the opposite of the low. It is the highest point that price action got to during this specific time frame that this candlestick represents, and then the close at the end of whatever time frame this candlestick represents. So the two major parts of the candlestick is the body of the candle, which is shown by the filled in green part here, and the wicks of the candle, which is shown by these two lines at the top and the bottom. These two major parts of the candlestick represent four different things we have to pay attention to, which are the open, low, high, and close of the candle. So for today's example, let's consider that this is a daily time frame. And for this daily time frame, what we would be looking at is a market that opened here at the beginning of the day, pushed down all the way to the low, pushed back up all the way to the high, before finally being pushed down once again and closing here at the end of the day, and then starting a new candle. And before we move on to what these candlesticks represent, we're actually going to do one more example. I'm going to show you guys a bearish candle. This would be an example of a bullish candle. They are normally represented by the green body that you can see right here. And the next example we're going to take a look at is a bearish candle, normally represented by a red body. We'll go ahead and change this to red now. And the difference between these two candles is very minute. The only thing that's going to change is here where we have our close. We're going to bring it down to the open. Here we have our open. We're bringing it up to the close. So what does this mean? For a bullish candle, the green candle, let's change this back really quickly. So for a green or bullish candle, you can see that our open is below our close. Our close up here, our open down here, meaning that this market closed higher than it opened. Now for a red or bearish candle, if we change this back really quickly, the only difference between these two candles is the fact that the open is now above the close. So this candlestick pushed in the downward direction before closing, meaning it closed below the open, signifying a day that the markets fell off, signifying a day of weakness out of any particular market. So in this example, we would have had a candle that at the beginning of the day started here at the open, pushed up to the high, pushed all the way down to the low, before pushing back up and finally closing at the close of our candle. So that's the anatomy of a candlestick, guys. That's exactly what each of these candlesticks is going to look like, and how we can define whether it's bearish or bullish based on the open and the close. It's also how we find the high and the low by looking at the top and bottom of the wicks of the candle. The top and the bottom of the body is going to signify our open and close. So with that being the case, what does each of these candlesticks represent? Well, every one of these candlesticks is going to represent a certain period of time. If we go up here on our trading view platform, you can see that we have 1 minute, 3 minute, 5 minute, all the way down to 1 hour, 4 hour, 1 day, all the way down to 1 month that we can look at. And considering we're on 1 day, each candlestick is going to represent 24 hours of price action. So at the beginning of 24 hours, we would have on Monday right here at the open. Throughout that time, we would go up to our high, down to our low, and all the way back up to the close. And on Tuesday, simultaneously, this candle would close and we would have another open of a candle starting that new 24 hours. The same thing exists if we are on a 1 minute chart. Every 60 seconds, we're going to have one of these candlesticks that represents 60 seconds of price action, 1 hour, 4 hour, whatever time frame you're on. That's what these candlesticks represent, is that amount of time of price action. The wicks show us where price action has been. The close and the open show us where price opened and closed. So hopefully that made sense if you're brand new. And if it did not, make sure to just go back and watch this section of the video one more time. What we're going to do now is actually head down to a price action chart and take a look at a few examples of candlesticks, where the open and the close are on each of those, and also how we can identify the low and the high. So I'll see you guys on the charts. Okay guys, so here we are. We are on the pound Australian dollar daily chart. As you see up here, we're on a 1 day chart, looking at the top left hand side of the screen. So what that means is each one of these candlesticks, red and green, represent 24 hours or 1 full day of price action. Our green candle represents where the market opened. Remember, right here at the bottom of the body, we have a low. At the low of the wick, we have a high at the high of the wick, and we have a close of that daily time period at the end of the day, right there at the top of the body. And that would represent our bullish day in price action. Now, for a bearish day in price action, the only difference is we have an open at the top of the body, we have a high at the top of the wick, a low at the bottom of the wick, and a close of that bearish day in price action at the bottom of the red body. Now let's do this for one more. And actually, let's go ahead and change time frame so you guys can see that. We're on the daily time frame now. What we're going to do is switch this to the 1 hour time frame. And here on the 1 hour time frame, we have an extremely similar situation. Instead of every day being represented by a candlestick, though, now we're looking at each hour. So let's say that this candlestick here, the red one, we know opened at the top of the body, right? Well, let's say it's 5 o'clock p.m. when this candle opens. We would see the candle open, move up to the high of the wick here, push all the way down to the low of the wick, and then push back up, and close right here at the bottom of the red candle body at 6 o'clock p.m., meaning that this candle represented 1 full hour of price action. Now, that would be a bearish version of 1 hour of price action. The bullish version would be represented by the green candle. Of course, we have the open, the low, the high, and the close of a bullish hour of price action here on our 60-minute chart. So now that we've talked about what these candlesticks are, how we can read them, and we fully understand the anatomy of a candlestick, we're going to briefly go over how we can use these candlesticks in combination with one another in order to predict market moves. And we'll get into a lot more detail about this later on in the course. This is just giving you guys a very brief overview of structure and trend analysis using candlestick charts. So let's zoom back out and take a look at that. So we're back out now on the daily chart of the pound Aussie. And what I want to show you guys here is that combining all of these candlesticks together, the red and the green ones that we just took a look at how to define, looking at all of them in a combination can tell us what trend the market's in, can tell us how to spot major and minor levels of structure in the market. And that's something we're going to go ahead and take a look at now, just very, very briefly. If you're brand new, don't worry if you don't understand this completely right yet, because we're going to get a lot deeper into this later on in the course. But as you can see, what we're looking at is red days and green days, representing days that the market fell off and days that the market rallied or pushed up. What happens is if we have a combination of more days that the market fell off within an impulsive move, this would be considered an impulsive move, then we get what we call an impulsive move down, breaking into new lows, which gives us the start of a downtrend. So what we then get is more green or bullish days than bearish days on a retracement, followed by yet again more bearish days or down days, putting us into trend continuation. So this is how we use candlesticks to actually tell us what direction the market is likely to go, because we know that a market in trend is pretty likely to continue in that trend. If we look at this some more, you can see that we have this pullback represented by more green candles than red, and then breaking into trend continuation again because of the fact that we have more red days than green. And I know that's a very simple way to put it, but guys, in reality, that's exactly what a trending market is. All it is more red days than green days. Or really, it depends on what time frame you're on. It could be more red hours in price action than green hours. So broken down into its simplest form, in order to spot trends, you're just looking for a market that's putting in more red days than green days over and over, pushing the market down. And we'll go through different rules that we can define this as, and different ways we can spot out structure levels. In order to spot structure levels, you would look at the lowest point, kind of like a candlestick. If you're looking here, you'd be looking at the high, You could consider this the body of the candle, this being the low of the candle. So if that helps you to understand swing highs and lows, then definitely use that technique. But what we're looking at is the swing high to swing low, and these swing highs and lows are going to be what represents major and minor levels of structure in the market. Again, we're going to go over that a lot more detail later on in the course, but hopefully this has been a great beginner's guide to how to read and understand candlestick charts. Now we'll go ahead and move on to the next section in the course, and I'll see you guys there.